Hello everyone, it's your favorite Green Waifu here, back again with another exciting topic to talk about. The difference between stocks and bonds and which one is better. I know it sounds like a tough topic, but don't worry, I'm here to break it down for you in simple terms. First, let's talk about stocks. Stocks are a type of investment that represents ownership in a company. When you buy stocks, you become a shareholder in that company, which means you have a small ownership stake in that company. Stocks are typically bought and sold on stock exchanges, like the New York Stock Exchange. As a shareholder, you are entitled to a portion of the company's profits in the form of dividends. You can also make money by selling your shares if the company performs well and the stock price goes up. Now, let's talk about the pros and cons of investing in stocks. One of the biggest advantages of investing in stocks is the potential for high returns. Historically, the stock market has provided an average annual return of around 10%. This means that if you invest $1,000 in stocks today, it could potentially grow to $2,000 in 7 years, assuming an average annual return of 10%. However, as I mentioned earlier, investing in stocks can also be risky because the value of a stock can go up or down, depending on the performance of the company. This means that if the company does well, the value of your stock could increase, but if the company does poorly, the value of your stock could decrease. Additionally, the stock market can be volatile and unpredictable, which can be stressful for some investors. Now, let's talk about bonds. Bonds are a type of investment that represents a loan to a company or government entity. When you buy bonds, you're essentially lending money to that entity with the expectation of receiving it back, plus interest. Bonds are typically issued by companies or governments to raise money for various projects. Here are the pros and cons of investing in bonds. One of the biggest advantages of investing in bonds is the lower risk compared to stocks. Bonds are generally considered to be less risky than stocks because they provide a fixed rate of return. This means that if you buy a bond with a 5% interest rate, you'll receive a 5% return on your investment each year, regardless of how the company or government entity performs. This can provide a stable source of income for investors who prioritize stability and income over growth. However, bonds also have lower potential returns than stocks in the long run, which is why they are often favored by investors who prioritize stability and income over growth. Additionally, bonds can be affected by changes in interest rates. When interest rates rise, the value of existing bonds can fall because they are less attractive compared to new bonds with higher interest rates. Conversely, when interest rates fall, the value of existing bonds can rise because they are more attractive compared to new bonds with lower interest rates. So, which one is better, stocks or bonds? The answer to that question depends on a variety of factors, including your age, investment goals, risk tolerance, and the current economic environment. Let's start with age. If you're young and have a long time horizon, you may want to consider investing in stocks, as you have more time to ride out any ups and downs in the market. If you're closer to retirement or have a shorter time horizon, you may want to consider investing in bonds, as they provide a more stable source of income. Now, let's talk about investment goals. If your goal is to grow your wealth over the long term, stocks may be a better investment for you because they have higher potential returns. However, if your goal is to preserve your capital and generate income, bonds may be a better choice. Bonds are generally considered to be less risky than stocks because they provide a fixed rate of return and are backed by a company or government entity. This means that you are less likely to lose your principal investment with bonds. Another important factor to consider when deciding between stocks and bonds is your risk tolerance. If you're someone who can handle more risk and volatility, you may want to consider investing in stocks, as they have higher potential returns. However, if you're someone who prefers a more stable investment, you may want to consider investing in bonds, as they provide a fixed rate of return and are less susceptible to market fluctuations. It's also important to consider the current economic environment when deciding between stocks and bonds. In times of economic growth and low interest rates, stocks may be a better investment, as they have more potential for growth. In times of economic uncertainty or high interest rates, bonds may be a better investment, as they provide a more stable source of income. Furthermore, it's worth noting that diversification is key to any successful investment strategy. This means investing in a mix of stocks and bonds, as well as other asset classes such as real estate or commodities. Diversification helps to reduce risk and ensure that your portfolio is well positioned to weather any market fluctuations. For example, let's say you invest all your money in one stock, and that stock performs poorly. You could potentially lose all your investment. However, if you diversify your portfolio by investing in multiple stocks, bonds, and other asset classes, you spread out your risk and minimize the potential for losses. It's also important to understand the different types of stocks and bonds available. There are many different types of stocks, such as growth stocks, value stocks, and dividend stocks, each with their own unique characteristics and risks. Similarly, there are different types of bonds, such as government bonds, corporate bonds, and municipal bonds, each with their own risk and return profile. When choosing between stocks and bonds, it's important to consider the tax implications of each investment. In general, the income from bonds is taxed at a higher rate than the income from stocks. However, if you hold stocks for more than a year before selling, you may be eligible for lower long-term capital gains taxes. Now, let's talk about some common misconceptions about stocks and bonds. One common misconception is that stocks are only for the wealthy, while bonds are for the middle class. In reality, anyone can invest in stocks or bonds, regardless of their income or net worth. Another common misconception is that stocks are only for aggressive investors, while bonds are for conservative investors. While it's true that stocks are generally riskier than bonds, it's important to remember that risk is relative to your individual circumstances and goals. For some investors, even a small amount of risk may be too much, while others may be comfortable taking on more risk in pursuit of higher returns. Finally, it's important to remember that investing in stocks and bonds is not a get-rich-quick scheme. It takes time, patience, and discipline to build a successful investment portfolio. However, with the right approach and a long-term mindset, investing can be a powerful tool for building wealth and achieving financial independence. In conclusion, stocks and bonds are two different types of investments with unique characteristics and risks. The decision to invest in stocks, bonds, or both depends on a variety of factors, including your age, investment goals, risk tolerance, and the current economic environment. By understanding the pros and cons of each investment and taking a diversified approach to your portfolio, you can minimize risk and maximize returns over the long term. I hope you found this video informative and helpful. As always, if you have any questions or comments, feel free to leave them down below. And don't forget to subscribe to my channel for more personal finance tips. Thank you for watching, and I'll see you in the next video.